Michael and Megan, thank you so much for coming into the office today. I know that we don't have as much time as we need to completely go through your comprehensive financial plan that I prepared, so I wanted to address one area that can have an immediate impact. And that area is liability management or debt management. But before I go into your debts, I do want to outline some of the strengths for your financial situation as it stands right now. First off, you're a dual income family with annual income of $124,000. That income is expected to increase by 5% per year. You currently have in excess of $10,000 of discretionary cash flow, and with some minor federal tax withholding adjustments, that amount will increase. And finally, you both have established brokerage accounts. So these are all positives that we can use. Now I want to take a look at the debt. The first debt is credit card debt of $4,300. Next will be the margin loan, Michael, in your brokerage account of $7,500. Third, your existing auto loans totaling approximately $40,000. And lastly, we'll talk about the mortgage at just under $145,000. So I want to start with the credit card debt. And while this is the smallest amount of $4,300, it does carry the highest interest rate of 13%. My recommendation is to tackle this immediately, and I would use funds from Fund D, Megan, in your brokerage account. Now this fund has a 5-year average return that's negative 6%, and it has a standard deviation of 20%. So it is a high risk fund, and it has a negative 5-year average on it. So in my opinion, it just makes more sense to retire a 13% debt, which is equivalent to earning 13% on it, than continue to maintain that position in a subpar mutual fund. Next, Michael, I want to talk about the margin loan of $7,500 in your brokerage account. Now, the interest rate on that is currently 8%, and you have money market funds of $6,667 that are currently paying you 4.5%. So we have a 3.5% deficit. My recommendation here would be to use the money market funds to reduce the margin loan down to $833, and then just simply write a check out of the checking account. This is a negligible amount. The checking account is not paying you anything. It's non-interest bearing, so it makes sense to retire 8% debt. The next thing I do want to talk about, though, is the auto loans or the auto payments. And this is the area of most concern as I see it in your financial situation. Your combined vehicle payments are $1,568 per month. This is 15% of your gross annual income and 25% of your net take-home pay. This payment, or these payments, right now cost you more than your mortgage. In my opinion, I would recommend that you research refinance options to try to reduce the loan amount and aggressively pay these down. This, in my opinion, is just too high of a debt to carry on a monthly basis. And finally, I want to talk about the mortgage. And here is some good news, but it does come with some caveats. So your current mortgage is at 9.5%. As I mentioned, it's just under $145,000. You have 27 years remaining out of the initial 30-year term, and your current mortgage payment is $1,244.46. So by calculating your total payments, if you continue to pay it out over the next 27 years, your total payments will be $403,205 to retire that $145,000 debt. So you'd asked me to calculate your housing cost ratio, and that's nothing more than your mortgage payments, your taxes, and your insurance. These total $20,336, and if I divide that into your gross annual income of $124,000, your housing ratio is 16.4%, which is well below the recommended maximum of 28%. So that's good news. Unfortunately, housing costs are factored into another ratio, which is a total debt ratio. Now, this ratio consists of your housing costs that I just outlined, plus all consumer debt, which we just went through. Now, if I total this up, or these amounts up, that's $43,454, which is currently 35% of your gross income, which is marginally below the recommended maximum of 36%. In my opinion, the vehicles are the main culprit of this being so close to the recommended ceiling. So, refinancing to a 15-year at 8.25% obviously would decrease the term and decrease the interest rate, but it would increase your monthly payment to $1,406. Your total payments would decrease from $403,000 by approximately $147,000 over the term of the loan. So that's obviously good news. Unfortunately, the increase in your monthly payment would cause your total debt ratio to creep up to 37.1%, which would be exceeding the recommended maximum of 36%. So ideally, you can reduce your other debts down, as I had outlined, until your total debt costs, including the increased debt or increased mortgage payment, are within the acceptable ranges, and then you can refi and shorten your mortgage down. Another positive or benefit to this is your mortgage would be retired before, or would be zero before you retire in 17 years, which would free up the cash flow of the mortgage payment. So that would require less capital per year. The other option, which would not require you to retire any of the other debt, would be to refinance to a 30-year. Now, by doing so, a 30-year at 8.75. Now, by doing so, your monthly payment would decrease by approximately $100 to $1,140. However, your total payments over the life of the loan would increase by over $7,000, and that's due to extending your mortgage another 3 years. Obviously, this is not advisable. The refinance on a 30-year, though, would be advisable if you continue to pay your current mortgage of $1,244. By doing so, you would be applying an extra $103 per month to principal, and this would retire the mortgage in 22 years versus 27 years. Now, again, paying the same payment, but retiring it 5 years earlier due to a lower interest rate saves you approximately $75,000. So both refinances make sense in my opinion. My preference and recommendation would be to get your total debt cost down to where you're eligible to refi for a 15-year. Obviously, the savings is $147,000 compared to a 30-year, roughly saving you $75,000. Now, the closing cost of 3%, regardless of which refi you're looking at, as we had discussed previously in our meetings, would be handled out of pocket. That's not factored into the calculations for the mortgage payments. But I do think it makes sense to strongly consider a refi. Does all this make sense?